to Assets Under Management. This is your host, Misha Kaufman, and
Gabriel Craft.
we sound super professional sometimes. So we're super excited. We've walked you through a lot of different parts of identifying properties and how we approach things. But one really important element that we're going to talk about today is just understanding what the market looks like at any given period in time. It's something that Gabe and I do every day, every week. Things change all the time, and you guys got to be on top of what the new products are, what interest rates are, what's happening in terms of dynamic shifts. Is there new product coming in? So that's something that we do pretty consistently. But we wanted to do something for you all where we kind of give you a sense of what the state of the market looks like in Texas at a given point in time. So right now it is Juneteenth. Happy Juneteenth, Gabe, and our listeners out there. And we wanted to give you a sense of, in this moment in time, what the state of the market looks like. And we will update this. So this will be something that we will do. What do you think? Quarterly, Gabe? Does that sound about the pace?
Yeah. Every 3 to 6 months.
Yeah, I like that. Every 3 to 6 months, we will provide that update. And with that, I'm going to throw it over to Gabe to kind of dive into this episode for us.
Yeah, so one of the things that's exciting that at least I find very interesting about investing in commercial real estate is it requires some knowledge about economics and what's going on economically. Because a lot of the drivers for an investment, if you went too microscopic and just looked at the fundamentals of a neighborhood, you might miss out on something that's going to have huge impacts to your returns. You might miss out on a recession that had some pretty clear breadcrumbs that it was coming forward in the next, during your holding period, or a boon, right? And you might underestimate and not pay as much as would make sense given that there's a boon coming. And so understanding sort of the macroeconomics, at least, you don't have to always go nationwide. Real estate is a local business, but we like to take a look at what's going on in the United States economy. Misha does a lot of investing in, your traditional market public companies. And so he kind of keeps a good idea of what's going on economically, what sort of industries are working, which ones aren't. And, I kind of dork out deep on the commercial real estate by always focusing on what's going on economically, also at the state level. And so I try to pay attention to the latest cues of what the state has done to make our jobs as operators easier or harder. For example, during COVID, it really made a difference what state you were in. In fact, we started learning the importance of understanding what's going on in your specific counties. And because Misha and I buy apartments, understanding counties at the taxes level and understanding counties at the program level that can help some of your sort of lower income tenants get support and additional funds, and understanding what's going on at the county level in terms of regulations and annual sort of certifications and things of that nature. So we really try to go, from the macroeconomic nationwide level to the state, to the major metropolitan areas, to the specific counties. But today we're going to talk about my favorite focal area, and that is the Dallas-Fort Worth market. Right now, it's going to be called the state of Texas because we'll start off with some of the brief topics that are a little higher level, talking about the economy at large and what's going on in Texas. But, the 3 topic areas, every time we drill down into the details, we're going to look at Dallas-Fort Worth. And that's because that's where me and Misha are looking. That's where we have fishing pole in the pond, and we're sort of waiting for the next amazing deal. We've gotten some decent bites, some singles and some doubles, but we're waiting for that triple or that grand slam. And we know it's on the precipice. We just have to continue to take stock of what's going on in the market. So I'll share with you all some of what I'm currently seeing. Let me go ahead and start sharing my screen here. And we'll really focus on these 3 main areas. So we're going to start by focusing on what's going on with occupancy, because occupancy is finally increasing again. And we're going to talk about what that means for any investments that people are making. I think we can talk about this one in terms of what's going on at the state level, because Texas is sort of leading the pack. And we can talk about what's going on nationwide, but there's a reason for occupancy increasing. And I think it's really key then to sort of think about forecasted growth in the state of Texas versus the rest of the nation. if we're looking at any commercial real estate, but particularly multifamily commercial real estate, understanding forecasted growth is key. And last, then we'll take all that information and synthesize it into what we'll look at as sort of a supply and demand outlook. And the supply portion of our business is something that we have to pay attention to, because there's all these other people that are doing these projects that aren't existing multifamily. They're raising a bunch of money to build brand new multifamily units. And so we always have to pay attention to that, because every real estate cycle has the natural boom and bust of supply and demand. And that's just typically what we find is these periods of hyper supply. We are in one right now. It's kind of a minor one. It's kind of a quick one, but we are in a hyper supply situation in the nation, and in particularly in the Sun Belt, which is an area that covers all of the stuff on the bottom half of the United States where it's a little warmer. So the state of Texas is also feeling that pressure of increased supply. And so I've said, okay, occupancy is going up. We've got some things to talk about in forecasted growth, but the highlight there, the sneak peek, is that we're doing really well on forecasted growth in Texas. So why is there still some issues with supply and demand? And we'll talk about the timing of that, why there's some brief oversupply, but there will very quickly be a huge undersupply and a consistent demand outlook that means that the fundamentals of this business are really strong. And many people for a long time have looked at multifamily and said, man, the fundamentals, especially in the state of Texas with all that growth, are amazing. But over the last 1.5 to 2 years of owning apartments in these Sunbelt cities like Houston and San Antonio and Dallas, it hasn't felt amazing. Shoot, Austin's feeling terrible right now, and it has nothing but strong fundamentals. But what's happened is we've hit a really strong pocket of hyper supply, and we'll look at that in detail later. When you're in this business, though, if you just had some investment strategy that is, I'm going to search really hard to find great deals in Dallas that are a little older. We're going to find great construction people. We're going to make those older properties great places to live, because fundamentally we believe in the neighborhood around those older properties. Then if you just quit anytime there's hyper supply or anytime there's sort of not as much ability to push on rents, you're not going to make any progress. And so in this business, what's been great is to work with somebody like Misha. Over the last 1.5 years, we've done pretty well. We've done pretty well despite so many headaches hitting people, including, I forgot to totally mention the increases in expenses, which have been quite the dearth in people's business plans and in their pro formas. But right now is the time to continue to march forward. So I think that's one of the things that I enjoy about in working with Misha, and it's why we wanted to create assets under management, so that we could have opportunities to talk about this topic of like, hey, we're going to keep doing this even while it's hard. Let's talk about what's going on while it's hard. And right now it's hard, but we've been digesting what's going on in Texas, and one of the big things is that for the first time, this just came out this month in RealPage. When you look at the last 2 months of occupancy, we've had improvements in almost all of the U.S. apartment markets. So broadly, for the last 2 years, occupancy has been tough. It's been dipping, right? There's been way less absorption than we would have thought. Way less people moving in, and more people sort of maybe moving back in with their family, or maybe two families moving into one apartment instead of each owning their own. And it's been partly to do with the fact that times are tough with a lot of the inflation. We saw people just slowing down in most markets when it comes to new creations of families. And then in even the amazing markets, we saw that the builders had over planned for this growth. And so they built too many units. So even where it was still really strong growth, where people were coming in from both coasts to go to these Sunbelt markets, we saw a lot of pressure on occupancy. But it's slowly but surely turned and stabilized. And in markets like Dallas and San Antonio and Austin and Houston, we are now starting to see occupancy slowly tick back up. Now, that has a lot to do with the fact that many of the responses by operators to oversupply has been to lower our rents a little bit. Didn't happen here in Dallas so much. Technically, we lowered rents by 0.9% on net new leases over the last couple quarters, but we also we're seeing overall rent growth because on lease renewals, we were kind of catching people up. There's been a lot of rent growth prior to the slowdown. And so ultimately, net, rents have grown in Dallas and in other major markets, except for Austin. Rents had sort of tapered off or grown slightly overall. In some markets like Austin, they had actually pulled back. But because of those lower rent prices, occupancy is really starting to come around and has ticked its way up. So there's some disparities there regionally. You look like at the Northeast, it's surprised a lot of people. Boston is doing amazing, but when you take a look at our market here in Texas, we have sort of Dallas and San Antonio and Houston doing a little better than Austin. Austin's such a small market and had so much new build there. So what I think is the key takeaway is that anybody that's going to own right now should be paying extra attention to performance on their operations because as you can see there's some supply and demand and some things to pay attention to. You've really got to be involved in the operations to understand where to pull the levers to maximize returns. And it's also probably better right now to stay focused on pushing occupancy versus trying to be the one to push rents. No matter how much rehab you're doing, you're probably not going to get much of a rent bump, but you can fill your property up to 100% by having amazing units and having amazing people on your staff to take care of your residents. I don't know if you want to add anything there, Misha. I do have a couple other topic areas, but I don't know if you have any other thoughts there on just sort of what you've seen across your portfolio here in Dallas.
Yeah, I think what you talked about is spot on. I mean, I don't always get a chance to look at the numbers the way that you do, but I've seen my occupancies increase pretty much across the board in my portfolio, where we usually were creeping 96 to 98%. If there's a gap, it's usually not because the demand isn't there. It's because we don't have ready product. So when we see our occupancy gaps right now, it's just because we don't have units ready for people to look at and move into, not because the demand isn't there. But there is that price sensitivity, which has changed a little bit. I think initially it was a lot easier to rent out 2 bedrooms and 3 bedrooms, and now people are a little bit more conscious about where their funds are going. So they're either going for that 1 bedroom or 2 bedroom, or applying with more people in a household to be able to afford those things. But like I said, as long as we got units ready, we got people ready to move in.
It's been fun watching you because I know you've actually literally the last 10 days or so, you've been spending a lot of extra time on a couple assets that we own together, making sure that the team is getting units ready quickly. So that's kind of what I meant by like absolutely stay focused on the operations and diving into the details right now. It's key. And if you do it right, you're going to be sitting in a position where you're able to make those tweaks and you're able to see that if you have made ready product, you'll be able to lease out quickly and stay sort of above the pack in terms of occupancy.
Yeah, and
Um,
I mean, one more quick point because we were talking about operations. So, I think you hit the nail on the head. Once you get people in the door, if you're able to provide a great experience for them, then they're going to be hesitant and reticent to leave. So it's okay to provide a little discount on the front end or have a little bit lower price as long as you provide an exceptional experience for them. And we've seen that for the most part, where renewals have been at a very high rate, even though we are offering pretty substantial increases. So that is something for those operators out there, owners thinking about doing this. Whatever we can do to get them in the door and then have that great experience is something that we've found success with.
One thing I'll just add on to that, and it's not related to what's on the slide here, it's not related to growth, but it's an asset management sort of pennies in the couch tip. Is sometimes you don't even have to give like a monetary sort of push a step back from your pricing on the renewals in order to keep that occupancy really high. We've been using, or sorry, one of my asset management mentors who I'm in a mastermind with, she was mentioning how she's been using the parking spots. So the reserved parking spots, she's been giving a couple months away for free as a way to get people to renew. So like, hey, if you renew, we'll give you 2 months for free. And she's found that not only is that sort of a great, almost free thing to give away because she has some additional reserved parking spots. It's as easy as painting a little bit of words, the words reserved on a parking spot. But if you give it away for 2 months, you'll find tenants get used to having it. And many of those tenants turn into the people that pay that extra 30 or 40 or $50 in Texas for that parking spot. So just a little tip there, like do those little things if you can to adjust and continue to keep heads in beds and keep your renewal levels high. But the macroeconomics aren't supporting you, you can't get there. So this second slide is about growth. It's the topic that I think is really interesting when you dial in to the metropolitan areas that me and Misha focus on. So this is a slide specifically set to take a look at Dallas. That's why you see the 8 million, 8.2 million, 8.3 million population there on the metro portion of this chart. And that's just referring to the Dallas metroplex. Other metroplexes are very similar here in Texas. They have very strong growth forecast. You can see the 12-month there. We're looking at 1.5% versus the US at 0.5%. 10-year change is 1.8%, and 5-year forecast will be an annualized. So it's the annualized number of how much it's going to be each year. In 5 years, I think it'll still be at an annual click of 1.4% growth. Just huge year over year growth, many households being formed. And what that means for us is there's going to be significant demand. I mean, you can see the population growth on the bottom left there, the labor force growth in the middle, and ultimately that's resulting in a lot of income growth, almost 3.5% income growth over the next few years, over the next half decade to decade. Large metros like Texas are still going to grow at maybe 2.8 to 4.4x the rate of the rest of the nation, right? So they're ideal places to invest. The fundamentals are strong. You just have to pay really close attention to your time horizons, right? If you're doing a deal that's going to depend on things turning around in a year, well, the next year isn't as rosy. And on the next slide, we'll be able to see what that supply versus demand looks like because we're going to take a closer look at what's happening in the construction world, okay? Because that's where it gets exciting. But overall, unemployment is dropping in the DFW Metroplex as it is in most of the other large metros in Texas. And according to CoStar, which is where we gathered this data, I guess they steal it from the Oxford economics team. But there's just extremely strong growth that is going to taper. It's still you're going to continue to have really strong population growth, but it's not only quantity, it's also quality. If you take a look at that median household income, it is forecast to be gigantic. And Dallas in particular, which is what we're looking at right now, is slated to be one of those cities that is on par with LA, New York, and Chicago. And it may even take over that third spot from Chicago or that second spot from LA because it's got infinite growth potential in all directions. It's a big circle. There's a lot of flat land around it, and it's really easy to expand out and grow from Dallas. So if they can continue to get all these big employers, all these giant corporations that are building large buildings downtown here in Dallas, it's going to be one of those really strong markets. And I just say that to say that, like, I'm waving the flag. Hey, now's the time to start working on your investments in, looking through the front window of your car, not in the rear view mirror. Okay. The rear view mirror kind of sucked. If you've done any investing in the last year and a half, 2 years in multifamily, they haven't been as strong as forecast. Expenses have been higher. Demand's been a little softer, and things just haven't been as easy throughout. There's just been a lot of things that have been a challenge. But the fundamentals that everybody keeps marching on about, saying, hey, no, just keep staying at this. Learn, get ready, invest, keep looking at things. They're going to be here. Keep going down and you'll get that progress. That's what's going on right now is we really got to stay focused on the data. And the data says, hey, this is a great situation to be in if you're in commercial real estate in some of these Sunbelt markets. All right.
Yeah, I was just going to add a couple other dimensions to that. If you could just go back to that previous slide real quick. So, at the same time, growth is what it is, and a median household income is rising, but the interest rates may still be very high, and what that means is people are going to be hesitant to buy houses at that price point, or because there's not a lot of supply in terms of houses in the DFW area, they're forced to look very far out, and they're being pushed out, and still are going to be paying a little bit more than they would like to. What that means for us is that your high income wage earner is going to be more likely to rent out an apartment at a higher price than they would to buy a house, because just the fundamentals aren't really there for them in that way. So us having strong assets in locations that people want to be close to where they're working, we're able to charge higher rent after a certain period of time because the alternatives are not going to be better for them.
I love that. Yeah, being in our 30s and 40s, we're looking at school districts. We're looking at proximity to the good jobs. We're looking at the what my wife calls the extras in a neighborhood, right? The people that are just walking their dog or out and about. And if you can check the box on all three of those, if you can buy assets in those kinds of neighborhoods, it doesn't matter if they're older. If you can kind of bring those things back to life and get them operating well, you're going to have a good time in these Sunbelt markets. So, I mean, at least that's been our investment strategy and our investment thesis, and it's suited us pretty well so far. And we're definitely seeing there's opportunity in that investment strategy moving forward. But overall in Texas, there's just a lot of growth. So whether you're looking at things like multifamily or you're looking at other areas, know that the growth is there. The growth is definitely there to support investments in this area. All right. So I'm gonna
The
walk.
only other thing I was going to say, and I know it's a tangent, but when you look at Texas, it's unique in some ways because you have very major big cities, um, your Dallas, your Austin, your Houston, and then you have a lot of pockets of nothing, or my opinion, nothing, or you have pockets that are surrounded by your these really big schools, right? Where you got your Texas A&M, Texas University, Baylor, and you'll see kind of within those schools are expanding as well, and that's where you're going to have kind of pockets of a lot of people residing. But it's just a very interesting market because I know when we talk about Texas, it's a huge array of different types of categories that you'll see depending on where we're at. But when we focus on those cities, because it's so concentrated, it's a really great opportunity for us. I think the other side that we didn't talk about that I don't know, Gabe, if we want to communicate is just the political atmosphere, and how that may work in our favor as investors, in terms of allowing these market forces to continue to move forward.
Just hopping back here, talking about that because I took a note here. Yeah, you want to have a business friendly environment. That's one thing. But what's really fascinating about Texas is also strategically where it's at in its geography. It has a border with Mexico. And when you look at where the future is heading, especially with this race to kind of get AI up and going, I was listening to really long podcasts about AI, and I kind of started diving down that rabbit hole. And it seems like where things stand is it's going to change a ton in the next year or two in terms of its capabilities and what kind of value it drives for the governments and the industries that are sort of focused on it. But where we're looking at is you've got some countries in the Far East, and particularly in China, and their limitation is on the microchips, like the chips capabilities. And then our capabilities is actually on our infrastructure in our grid and our ability to provide enough energy to these server rooms and these server areas. And so what I was been tracking, because particularly because I live near sort of a tertiary market called Sherman, where where Texas Instruments is building a gigantic, almost a city, like a multi-billion-dollar investment into a microchip facility up there that's going to create a ton of jobs. It made me start looking into how and why that's happening. And that's because a lot of the investment that the United States and even the whole West, right, all of Europe, makes into the microchip business, it was spread out in places like Korea, Vietnam, China, and whatnot. And they were really dependent on overseas for these critical pieces to our world, things that's in both of the computers that me and Misha are talking about. As they decide to change up the supply chain, they're looking to places like Canada and Mexico and other parts of Central and South America to produce so that it's easier to get here. And also because of COVID, it's not going to, it made it realize that these boats, it could take months and months and months and stop your supply chain if you have issues across the seas, right? Or if there's wars or whatnot. So I say a lot to say, some of those southern big cities. So if you think about like San Antonio's proximity to the border, McAllen's proximity and that whole valley area's proximity to the border, and of course like El Paso, places like that, and Houston, you're actually going to see a lot of growth from the influx of great businesses in northern parts of Mexico that are creating stuff, and then there's trucking, and there's a lot of pass through economics and labor in the logistics space and in other spaces around production. So just a lot to look for in Texas. That border situation is going to allow Texas to really continue to thrive. And I don't think that's reflected in these sort of 10-year change and 5-year forecast items. I really believe that Texas is going to outperform even what we see here.
Yeah, I think, and then the other aspect, I'm sure we'll cover it too, is talking on the political sphere on both ends of the side. I think there's been a shift that's happened clearly in the last 6 years to I would, when I say America First agenda, I'm not talking about from a political perspective, but in terms of like keeping jobs in the United States. And one of the main beneficiaries of that has been Texas because they are so business friendly. You're seeing a lot of your major companies coming to Texas and starting to actually focus more. Initially, it was mostly Austin. So you got like your Teslas and your other companies going there. But it's starting to shift up to Dallas because the infrastructure is already there. It's pretty robust in terms of being able to provide places for people to move to, and I think in Texas understands that from a government perspective, so they're going to do everything they can to facilitate that process, which is going to allow us as investors to really be in a prime location that's going to just continue to build momentum regardless of what happens politically.
Yeah, and so that's good, good, and good, right? And I think Misha also highlighted one of the areas that I would say is net bad as a person living in Texas, which is housing prices are also staying pretty darn high. And we have seen some relief on the property taxes, right? Because as more people have moved here and more money's gone in, they've kind of oversubscribed. Things grew so quickly, they got too much money. So they've lowered rates a little bit, way closer to that like low twos or even high ones in terms of percentage, which is great. It's starting to get a little more competitive to other states, but it's still relatively high. It's how we fund our schools, it's how we fund our roads in some cases. It's how we fund things, right? We don't have an income tax here. That's why people love it. But we do have a pretty high property tax. And so it keeps single family homes really high, really expensive. My mortgage, my mortgage is like $1,500 or $1,600, but I still pay an extra eight and then nine and then near $1,000 in property taxes as my valuations increase. And so it is an interesting dilemma to be in Texas with sort of some of the political things that are going on, but also some of the local economic things that are shifting the growth. I think for commercial real estate and multifamily in particular, the fundamentals are there. I've been waving that flag for the last 30 minutes. I'm going to keep doing it for the next 10 or 15. And let's take a look at the key piece of data that gives me that level of confidence. And so Misha and I laugh about this sometimes because we're just like, man, what's going on? There's buildings everywhere, right? We're driving into work. We drive down this really nice tollway, and you can see it on the left and the right the whole way down. There is a ton of new construction in Dallas, and it's a little tough to see, but if you zoom your eyes in there, the forecasted amount is approximately 9,200 units. That's about the need or demand on average over the next 5 years. As you should note, if you take a look at the dotted line near the 2004 mark, the first quarter of 2004, which is where we have this data from, there's more supply than there is demand. And when that happens, prices go down and occupancy goes down, right? That's what's happened is it takes 3 years to build these things. So you want to draw a little line in 2001 and think about what was happening. It was so cheap to borrow money and build new construction. And it was really hard to buy existing stuff. So a lot of people were like, hey, forget this. I got several $1,000,000 over here. I'm going to go ahead and build something brand new rather than fight all these buyers to try to overpay for something that's already existing. So a bunch of new things started then to be built. And what happens is those things start coming online, meaning they start being ready to lease up and get tenants moved into them 2 to 3 years down the road after they've started. So if you start in 2021, when does all the supply hit? 2023 late and early 2024 through mid 2024. And that's exactly what we have going on. And so that's the scenario we find ourselves in. There's this amazing amount of new supply hitting the markets that we care about. That's what we've called out Dallas Fort Worth. It's even worse in Austin. Okay. It's bad in Houston. It's bad in San Antonio too. They're all relatively bad when it comes to what's happening right now. But it's starting to burn its way through because the demand is so friggin' strong. So there's this giant chasm between the dotted line that runs across the horizontal and the orange line with the black stripes in it that slowly dissipates and falls off. And it falls off because in 2022, it got really hard to borrow money to do new development. In 2023, it was near impossible for people to get projects that were already well underway to get going and get started. And so what you're going to have is, as 2025 and 2026 come through, you're going to see a huge, huge decrease in the number of new units, particularly in Dallas, where land got expensive and construction costs got expensive and borrowing costs went through the roof when the Fed started raising interest rates. And then most of these loans are like from a small bank or from some sort of loan that's based on the Fed's rate or something derivative of it. So they can be very expensive to borrow. We're talking about 10, 11, 12% to do some of these construction projects. And it's just made the numbers not make any sense anymore. And for people that are buying existing assets, it's going to be a scenario where I believe that the rents that we're forecasting to be able to increase will actually be much higher than our forecasts. And that's just based on this fundamentals. Until something changes here, with that 9,200 units or so needed per year, and the ability to maybe build 6,000 and then 4,000 and then as low as only like about 2,000 units coming on, it's really not going to be enough deliveries to take down the demand. And we're going to have an opportunity to either really fill up our units and keep rents moderate, or push those rents, or do both, fill up the units and push rents. And so it's a great time to look at what to do to be in a position to buy multifamily or other commercial real estate that's got a similar demand and supply imbalance. And I think it's why we're excited and slated to just grab whatever we can here in the major metros throughout Texas, with a focus on DFW, with Dallas Fort Worth sort of being our top spot, because new construction is just not going to be able to keep up with demand.
So I think what that graph shows as well is a difference in terms of how we will approach investing than a lot of people. So some people are very short-sighted. Oh, right now in this moment, I'm not going to get what I want, so I'm not going to do it, right? But we try to think long term. So we're thinking 3 years out, 5 years out, 7 years out. So we can make decisions in the interim that may be a little bit painful, but in the long run is going to put us in a really strong position. So that's what you can see from when we are looking at assets to buy now, where the fundamentals may not look as great as it may in the future, or the fundamentals may not look as great as one would think. We're projecting out and we can see what the future is going to look like based off of just this supply and demand information and our local market information. And we know that now is the right time, because if we wait, then there's going to be a lot of other people coming in that door, and it's going to take away the opportunities that we see. So it's the right time for us to be fishing when a lot of people are on the sidelines, because that's when we're going to find the best fish, in my opinion. So I just wanted to kind of share that perspective on it.
And I have some mentors that are sellers right now, and it's terrible for them because, as you can see, the supply, that orange, it's brand new stuff. It's really attractive stuff. And they're out there trying to sell an older unit, right? An older property, maybe 100 units that's built in 1970. And there's not a lot of people interested in buying, because when they run their numbers, they're not really able to get too aggressive about rent increases or occupancy increases, and they don't have to. They can set pricing right now based off of what's happening today. That's the beautiful part about these larger multifamilies. It's all based off of how much money are you creating right now. And that's kind of the way it's supposed to be dealt with. And in Dallas Fort Worth, there's a lot of competition to be in the best markets. There's a lot of money out there in general to invest in stuff. It's been sitting on the sidelines making 4, 5, 6% in treasuries, right? There's a record amount of money just sitting in US treasuries. But as treasuries stop paying out as much, as treasuries sort of chill out, we're going to end up seeing a lot of that money pour into something. And I believe it's going to be pouring into multifamily down the road, after me and Misha have been able to grab some sort of poorly operated assets and turn them around. That's just a very bullish approach from us. But overall, the Texas market, man, I think that there's this strange belief right now that because things are tough, that Texas must not be growing. And that couldn't be further from the truth. It's just that Texas is growing at such a fast rate right now. There's people building stuff and leasing it out, and that's made the current owners have a little bit of a hard time. And expenses have also gone up. And we haven't seen quite the craziness in terms of labor pay rates, so it's tough for the working class communities. But that will shortly sort of subside, and there's going to be this huge opportunity for me and Misha and others like us to kind of see, hey, now's the time to continue down this path of being an investor in the multifamily space in the Sun Belt, and in particular markets like we like that are pretty well diversified and have good economics, good policies, good politics, like Dallas Fort Worth.
I'm going to end us with like a really bad analogy, and bear with me. I just had a baby, so I haven't got a lot of sleep. But imagine that you are on a lake, right, and you're in a sailboat. So the first thing that's great is that we have the headwinds moving in our favor, right? So before anything else, what's going to allow us to get to a destination is all the economic factors that Gabe just talked about. But we also have that boat, right? So which is our strategies, the approach that we're taking to this situation to get us there. And then the last thing you need is the right people to steer that ship to get us to where we want to be. And that's where we are too. So we got to have all those elements come into place, and we think that is uniquely situated right here and right now, and that's why I'm really excited for what's to come.
I'm going to get a crew shirt because I love that analogy. Yeah, that's really fun. Yeah, you got to have the right crew on board. There's really no winning the competition in a sale competition when it comes to having the wrong crew. But if you got good wins and you got an amazing boat, right, you're going to kick butt. And I think that's what we have going on right now at this unique moment in time. But I do a lot of the acquisitions piece, so I interact with brokers and such. And just a real quick hitting the older assets don't have a lot of buyers. I mentioned that earlier, but I want to call that out for people that are interested in that factoid. There's really not a lot of interested parties. You're going to get 5 or 6 LOIs on these older, larger assets because they're hard to raise money on because investors don't really want to come off the sidelines and put their money into something that has some risks from a construction standpoint, from a older pipes, older electrical, older system standpoint, and yet it's not cash flow in day one, right? Like as it should be. And so I think there's just been a lot of these crappy deals that were overpaid for, and the owners can't really drop their pricing down to make the deals make sense because they would lose all their investor money. And so they're fighting their tooth and nail to try to pretend and put some shininess on some objects that aren't really worth as much as they think they would want them to be. And so you're seeing some issues with older assets in terms of having buyers, and that's just an opportunity for the right buyers to be super patient and take down the ones that actually do make sense, the ones that we actually can see a very clear path towards doubling investors' money over 3 to 5 years. And what we're going to end up doing is being patient in June and keeping looking at those deals that aren't quite working yet. There's some that are being done behind the scenes with the banks themselves. So the deals are performing so poorly that the bank goes, hey, you current owner, not only are we wiping all your investors' capital out of this thing, but we're going to go ahead and find some people that we know as the bank that can go ahead and take this thing over and do a better job with it. So they actually don't hit the marketplace. And you've got to have enough strength of relationship with sellers and with brokers and even with some of the banks in order to understand what's going on right now. But in June 2024, there's not a whole lot of transactions on the marketplace. There's just not enough value there for the buyers, and these sellers are trying their hardest to work it out either directly with the bank or with their investors asking for more money or with their on-site teams in terms of turning the operations around so things can be making money. So there's definitely some pain points, at least here in Dallas, Fort Worth, and in Houston, where a lot of my buddies do deals, and in San Antonio, where I own and have learned from the purview of my friends that have property management companies down there that it's very similar. And then in through Austin, where we can read a lot of the commercial real estate news related to that market. There's just a huge oversupply and a lot of pain right now. I think the big thing to look forward to is what's going on with the treasury rates here in Texas. That matters a lot because we're borrowing at pretty good leverage on these deals, and we just want to make sure that we're sort of able to make money day one, doing something better than you'd be getting if you put your money into a treasury. And so I think that we're going to see a lot more deals take place September, October, November. And Misha and I will check back in at the end of the year and kind of give you a state of the union if we do see something interesting happening. So appreciated your time, but Misha, you can end it out. I just wanted to kind of
Yeah,
say
yeah.
there's
No, that's
definitely
great.
some interesting deal flow is a problem because we are in the middle of that dotted line where there's a lot of oversupply. So it feels to everybody like we shouldn't be doing transactions, even though if you look forward, there's a real huge opportunity. And there's still a ton of people who know that. There's analysts all throughout the United States that are pouring their attention to Dallas and Houston and San Antonio and Austin and other smaller markets in Texas. But pulling the trigger is another thing. And I think people are just being really, really, really patient, and they're trying to find that bottom of the market. And that's maybe not always the best strategy. Pick your investment strategy, find the good deals, and don't try to time everything perfectly. But I think there's a lot of timing going on from people because they felt the pain of the last few years, and it's real easy to talk about being greedy when others are fearful, but it's real easy to be fearful when others are fearful because that's just how we operate. And so, that's kind of what I'm seeing in Dallas right now.
Love it. No, I don't think I got anything else. This was a great session. I look forward to, continuing to inform you guys as the weeks go by. So let's sign off for tonight and stay tuned for our next episode.
Misha, thanks for taking the time away from your beautiful little new one and knocking this content out with me. Definitely, let's get excited for our next one. We're going to start having some guests on. So we're going to be talking
Yes.
taxes and what it looks
Yeah.
like for new investors, medium into the process investors, and sort of people that have got this investment passive thing going on. So I'm very excited about bringing some new faces on to the conversation. More to come soon.
Sounds good. All right, guys. Have a good one. Bye.